A country with more proven oil reserves than Saudi Arabia, 304 billion barrels, 17% of the entire planet's supply, collapsed into economic ruin over the last decade. Production fell from over 3 million barrels a day to barely 500,000. Hyperinflation destroyed the currency. 7 million people fled. And then, in early 2026, the United States moved in with military force, arrested the leader, and established control over the oil sector and frozen assets. The provocative question hanging in the air: did America just buy a distressed oil giant at a massive discount? Let's put aside the politics and the humanitarian crisis for a moment and look purely at the economic mechanics. Venezuela isn't just any oil producer. It sits on the largest proven reserves in the world, bigger than Saudi Arabia, bigger than Canada, bigger than Russia. But there's a catch. Most of it is ultra-heavy crude from the Orinoco Basin, thick as molasses, expensive to extract, expensive to refine. Before the collapse, Venezuela was pumping over 3 million barrels a day. By 2024, that had cratered to around 700,000, and by some estimates even lower. American sanctions, starting in 2017, cut off financing for the state oil company, PDVSA. Then, in 2019, the U.S. banned imports of Venezuelan crude entirely. Venezuelan oil that used to flow north to Gulf Coast refineries got rerouted, mostly to China, some to India, at steep discounts. We're talking $20, $30, sometimes $40 below the benchmark price. That discount is the first lever. Here's how the money works. When sanctions squeezed Venezuelan exports, global supply of heavy crude tightened. American refineries on the Gulf Coast are designed specifically for heavy oil: Venezuelan, Mexican, Canadian. When Venezuelan barrels disappeared from the market, those refineries had to bid up the price for alternative supplies or accept lower throughput. The spread between light crude and heavy crude widened. Refinery margins, the difference between what they pay for crude and what they sell in gasoline and diesel, jumped. Some analysts estimated U.S. refiners gained hundreds of millions in extra margin annually just from the supply shock. Sanctions didn't just hurt Venezuela. They redistributed oil rents toward American processors and traders. That's the core economic logic. Control the export licenses, control who buys, and you control the flow of money. Now the U.S. has direct influence over Venezuelan oil. If production is allowed to recover, even modestly, the numbers start to look interesting. One scenario: lift some restrictions, bring in limited foreign investment, stabilize output at 1.5 million barrels a day within a couple of years. That adds roughly 800,000 barrels of daily exports back into global markets. At $80 a barrel, that's about $24 billion in annual revenue for whoever controls those flows. For American companies, that means access to cheap feedstock again. For traders, it means lucrative arbitrage, as Venezuelan crude sells at a discount, but can be blended and upgraded. For the U.S. government, it means leverage over global prices and a counterweight to OPEC Plus production cuts. If Saudi Arabia and Russia try to restrict supply to push prices up, Venezuelan barrels flooding the market can undercut them. That's strategic insurance. The aggressive scenario is even more dramatic. Restore production to 2 or even 3 million barrels a day, the level Venezuela hit in the early 2000s. That would require massive investment, tens of billions of dollars over 5 to 10 years, to repair decayed infrastructure, drill new wells, upgrade refineries, rebuild the supply chain. Who pays? Likely a combination of American oil majors, service companies, and debt restructuring that converts some of Venezuela's external obligations into equity stakes. Venezuela's external debt is estimated between $150 and $170 billion, much of it owed to China, Russia, and bondholders scattered globally. If the U.S. orchestrates a restructuring that prioritizes American creditors and investors, billions in claims get reshuffled. Frozen Venezuelan assets, estimated at several billion dollars in accounts and holdings abroad, can be redirected. Think of it as a fire sale. Creditors take a haircut. But American firms get first access to production contracts and export rights. The prize isn't just the oil in the ground, it's control over the financial architecture around it. That's the optimistic pitch. Now here's the reality check, and it's brutal. Restoring Venezuelan production isn't like flipping a switch. The infrastructure is in terrible shape. Decades of underinvestment, equipment stolen or cannibalized, skilled workers long gone. Heavy oil needs diluents to flow through pipelines, specialized refining, constant maintenance. Even with tens of billions in investment, you're looking at 5 years minimum to see meaningful output increases. During that time, the U.S. would be pouring capital into a country with a history of political instability, corruption, and weak rule of law. If a future Venezuelan government decides to nationalize foreign assets again, like happened in the 2000s, those investments evaporate. The economic benefits could be far smaller than the headline numbers suggest, and they might take so long to materialize that the entire venture becomes a gamble rather than a sure bet. Then there's the question of who actually profits, and this is where the story gets uncomfortable. The refinery margin gains? Those flow to a handful of large processors on the Gulf Coast. Specific companies, not the American public. The arbitrage on discounted crude? That goes to traders and intermediaries playing the spread. The debt restructuring? Bondholders and legal firms negotiating the deals walk away with the fees and settlements. These are narrow interest groups capturing very specific rents at very specific choke points in the oil supply chain. For the broader American economy, the impact is far murkier. Cheaper oil theoretically means lower gas prices, which helps consumers. But Venezuelan heavy crude was already being sold globally at a discount. It's not like those barrels were locked away. They went to China and India instead of the US, but they still added to global supply. Redirecting them back doesn't automatically translate to cheaper prices at American pumps. It means different buyers and different profit margins for different companies. The macroeconomic benefit for ordinary Americans could be surprisingly modest, possibly negligible. And then there's the cost side. Military operations cost money. Stabilizing a collapsed country costs money. Managing a transition government, preventing widespread unrest, securing infrastructure against sabotage, all of that requires ongoing expenditure that could easily run into tens of billions over several years. Meanwhile, Venezuela's oil revenue, even if it recovers, has to be split many ways. Paying down debt, funding the Venezuelan government, compensating investors, covering operational costs. The net benefit flowing back to American interests might be a small fraction of the gross numbers being thrown around. The geopolitical blowback adds another layer of risk. China and Russia both have major stakes in Venezuelan debt and energy projects. Cutting them out strains those relationships further. Other oil producers might see American control over Venezuelan supply as a threat and tighten their own production in response. OPEC+ could cut output to offset any increase from Venezuela, keeping prices stable and nullifying the strategic advantage. The global oil market doesn't sit still while one player makes a move. So what did the US actually acquire? Not a cash cow, not a jackpot. What it got is something more complicated and far less glamorous. A broken oil infrastructure that might take a decade and hundreds of billions to fix, sitting in a country with deep political fractures and a history of asset seizures. The leverage is real. Control over export licenses and debt negotiations gives American firms valuable positions in the global oil trade. But leverage isn't the same as profit, and positions aren't the same as payouts. The real winners are narrow and specific. Refineries that get cheaper feedstock, traders who play the discount, financial firms that restructure the debt. The broader American economy gets strategic optionality, the ability to influence oil flows and pressure OPEC+. But that's an insurance policy, not a revenue stream. And insurance policies cost money to maintain. Venezuela isn't a prize. It's a very expensive bet on a very long timeline where most of the upside goes to a small circle of energy companies and financial intermediaries. Most of the costs get spread across taxpayers and anyone holding the bag for reconstruction. And the ultimate payoff depends on everything from global oil prices to Venezuelan political stability, variables no one can control. The 300 billion barrels sound transformative until you realize they're locked in deposits that are costly, slow, and risky to develop. What looks like a distressed asset purchase at a discount might turn out to be exactly what it appears: buying someone else's problem at full price.